Okay, welcome everyone. We'll start our first lesson. Today lesson will go through our LO1 learning outcome 1. My name is Anjum Sattar and my email address anjum@ukversity.co.uk. Before starting this session, we'll go through what we're supposed to be learn under this unit, under this subject area. So this is financial reporting unit, and if you want to look around with other courses, you can look around F7 in ACCA, which is about financial reporting. And the aim of this unit is to ensure the student have a sound understanding about techniques, double entry bookkeeping, recording transaction, adjusting financial record, non-complex, the financial statements. We'll go through double entries, we'll go through how to prepare, how to record, and non-complex accounts. That's the key. And we have a learning outcome. Each lesson will go through one learning outcome. Today's learning outcome 1, be able to prepare financial statements, sole trader and partnership. Then we have assessment criteria. This will be in your assignment. Prepare the statement incorporating relevant adjusting sole trader financial statement incorporating relevant adjustment partnerships, and then we'll go through the purpose, discuss the partnership sole trader, and we evaluate the usefulness of these statements, how we can use, and various stakeholders those can use. Then we'll go through second learning outcome in second lesson, company's financial statement. Lesson 3 will go through interpretation, which is financial ratio. So then we have an inductive content each lesson, which will try to go through all the keywords what we're supposed to be learn, and that's all which will be in our lesson. So if you not get anything, maybe some one element we can't cover, but I'll explain you. Maybe it's not in every word in my slides, huh? But
Okay.
you all working in accounts, so hope so you already know, but I'll try my best to explain you each and everything. Okay, let's move back to our slide. So lesson 1, learning outcome 1, be able to prepare the financial statement, sole trader and partnership. And so always good to be when you start any activities, always reflect how much you know, what you think. 1 to 10, sole trader and partnership financial statement. Do we know we prepare 1 to 10? What do you think? Where are you up to?
Yeah, to be honest, financial statement, I know how to make it on the sole trader partnership as well, but there is partnership. I have a little bit confused on the partner's capital account and the current account. Sometimes I'm confused.
No problem. Those will go through. And what do you think? You are at 6, 7, 8?
Yeah, 6, 7, 8, 8.
Okay, no problem. And that's fine. Always good to be reflect, what we know, what we don't know. Yeah. And because
Yeah.
it's always reflective practice is really good. Okay, this is all inductive content which I mentioned you. So first we'll go through what is the key difference between sole trader and partnership. We all know sole trader 1%. Yes.
And the partnership, yeah, partnership is minimum is a 2-person, and their main object is to earn a profit with legally. So that means this is by law, they make a contract.
Okay, good. So do we know how many maximum partner can be in a partnership?
I think I forgot it's
No problem. It can be 2 to 20
2
in
to
the
20.
under the Partnership Act 1890. Which year? 1890.
1890.
Partnership Act. Okay, we
Okay.
can, but in other country, if we have a insurance and business, banking business, partners can be 2 to 50.
2
Okay,
to 50.
normally 2 to 20. So limited liability company, we can registered partnership LLP, especially accounting firm, limited liability partnership, many partners, yes, doing
Yeah.
different elements within, and that can be registered in the company house, limited liability partnership. Then it become incorporation. Okay, so this will go through then non-profit. We know the charities, charities work under the Charity Act 2011, registered with the Charity Commission. Yes, that's 2011. Charity Act 2011 we follow. If you want to further look around the legislation, you can dig out.
Okay.
Okay, then we have a limited liability. We know limited liability meant by nobody can claim your first personal assets. Yes, we can look
Yeah.
around sole trader partnership funding. Of course, sole trader 1%, partnership 2 and more.
Yeah.
We can, in companies normally we apply IAS 1. International Accounting Standard 1, which is about how to prepare, present financial statements. Do
Statement.
we know how many types of financial statements we prepare?
I think the income statement, financial position, statement of cash flow, and changes in equity. Statement of
Brilliant.
changes in equity.
Okay, so first statement is comprehensive income. Under IES 1, we can say statement of comprehensive income, or we call profit and loss income statement.
Yeah.
Second statement is a statement of financial position, which is also known as balance sheet.
Balance sheet.
Third statement is a statement of change in equity, we can say, yes, which shows how much dividend we paid, how much profit, retain, earning, revaluation, bit and pieces, and all is a part of balance sheet as well, equity figures. Okay, the next statement is statement of cash flow, and under cash flow we have three types of activities. We have
operating investment activities and finance activities
and financing, and this breakdown under IES 7 as well. International Accounting Standard 7 is about. Okay, so that's really is all about, and limited companies and companies. Okay, so of course each, I don't need to really go word by word, advantage, disadvantage. The partnership, of course, 2 and more, it's a different experience. Risk and reward can be shared, and disadvantage, sometime conflict can be between partners. That's the key thing, yes. And
yeah.
and that's other problem we have in Partnership Act 1890, as we discussed. Then we have a companies accounts, which we'll go through in second lesson. But Company Act 2006. In the world, if you're following international accounting standard, we called IFRS, International Financial Reporting Standard. In UK, we have FRS, Financial Reporting Standards. IAS, always purpose of financial statement to provide true and fair, not like we heard about maybe Enron, WorldCom. We maybe heard about Carillion companies, Carillion construction company in UK. We heard about Facebook, £4,000 tax. Maybe we heard about Tesco. The sale turnover was 180 million, shown 225 million. So these shouldn't be, because it's our purpose to provide true and fair. But accountant always true and fair. Always we need to think about, yes, limited liability partnership, and these can be under the Company Act. Okay, so when we deal with the double entry bookkeeping, always keep the rule debt click. Normally we use the word debt click. What goes on debit, what goes on credit. So every entry is a dual effect. Always write the double entry on your piece of paper. So what goes on debit side, expenses, asset, drawings, when these increase. When these decrease, opposite debit is a credit. Click is represent credit, liabilities, income, and capital when increase. So when decrease, we have to do debit. So opposite debit is a credit and credit is a debit. One thing can be replaced with other thing. That's always we need to keep in mind, and we can double help. So when asset increase, we do debit. When decrease, so you have to differentiate which one is an asset, which one is a liability. Asset is mean anything you own it which has the economics value, a resource controlled by entity which will flow the future economics benefit. Anything you own it not give economics benefit, it's not anymore asset. It's not come under, and we shouldn't show in our balance sheet, such as broken chairs and table. We saying furniture and fixture we have a worth of, but actually is not worth of anything now. So we should off the balance sheet. Okay,
Okay.
liability, income, revenue, and always follow the rule tax for the tax planning, because maybe you're putting as expense and you can reduce the tax bill of your
Mm-hmm.
client and the capital allowance as well. So if you're deciding to give the advice to customer, your client, that either you buy the asset, you lease it, always follow the capital allowance. Yes, which
Capital.
way
Yeah.
which way is more beneficial other way, and look around clients cash flow as well. So all these things impact. Okay, expenses, equities, if we all know, so I don't need to score debit and credit. So you
Yes.
follow the rule, double entry bookkeeping. Okay, next we have a depreciation. Depreciation is expense which we
Yeah.
charge. So is it depreciation? What do you think in term of tax calculation? Depreciation is allowed expense?
Depreciation for tax calculation is not allowed.
It's not allowed. So we have to add
No,
it back always.
we have to add it back.
We can show in the profit and loss whatever our policy depreciation based on the realistic surveyors are experience, but depreciation is it's not allowable expense in tax.
That's
So
not
we need in the profit and loss figure we need to add back our, and then we need to claim the capital allowance
capital
or
allowances.
any other allowance, which we can, like a personal allowance 12 and half. But depreciation is not. Okay, so thus we need to think about. Okay, then we have a method we use straight line, same depreciation every year, and diminishing balance method also is called reducing balance method. So only you need to be remember when we're using the straight line. Let's say we have a 2,000 pound is a value, and 5 years this asset we use, and at the end we can sell it. Let's assume 500 pound. So that's the scrap value. So now we need to be 2000 minus 500, and then we need to divide on 5.
Yeah.
So
That
that's
means
we.
the asset is reduced gradually over its useful life.
Yes, it
This is the
is, but in the straight line we will state it's mean every year depreciation will be the same.
same. Yeah.
But if we have a diminishing balance method, so always the previous year depreciation, we call accumulated depreciation, we need minus to calculate, and
Yeah.
always we need to be find the carrying value.
Carrying value.
Value always known as net book value as well.
Yeah.
It's no difference, and then maybe you can think about economic value or value we can say value in use,
Yeah. Value needed.
and the fair value. And then of course we can look around IES 16, International Accounting Standard 16 about. Okay, fair value adjustments we have to do sometime in assets. I'm not going in detail. That's under companies mostly we use. Okay, and
Mm-hmm.
then unit of production method is so how many unit machine can make, and they are how many they already made, and we can allocate the value or the depreciation accordingly, according to the unit of production. That's one
Yeah.
other method. So these are the three methods we use for the depreciation. NCA is called non-current asset. Non-current asset mean the asset which we can use more than a year, like property,
Yes.
plant, equipment, and we have a separate register. If you're using Sage, so under Sage you can create as well non-current asset register, and you can look around as well.
Yeah.
Okay, so next we have types of errors. We have major four types of errors. Omission, we can miss something. Original entry, maybe we put other way around. That's we need to be make sure we'll do proper following. a reversal of entry. Sometimes we have to reverse other way around. Maybe we recorded, yes.
Yeah.
Sale normally credit and sale ledger control account is the debits. What is meant by sale ledger control means trade receivable and debtor. If we have a
Yeah.
credit sale, then we have a sale ledger control. Principal, always you error of principal, maybe we doing debit or vehicle at cost, but actually that was the vehicle repair. So it means vehicle at cost goes in the balance sheet. I'm treating as an asset instead of as expense. So that's the
Mm-hmm.
principally wrong. It's we can't deduct it in our trial balance, but this is the wrong way round because expenses go so we can under and overstate things, and this is people use the creative accounting.
Yeah.
We don't need to be too creative. Okay, we should be true and fair. Okay, commission, error of commission, that we can look around debit, credit, yes.
Mm-hmm.
Entry wrong amount can be, that can be, we need to be look around and we can compensate. Entry duplicates, yes, that can be, so we need to remove it to cross out. Always keep in mind that can, and maybe that's the reason your account's not balanced. Of course,
Yeah.
we know that we can create the suspense account to do it, yes. At the start, at the end, we'll cross out amount balance incorrectly transferred. That we need to be look around as well. And these errors always, and especially in Sage, balance previous year, you need to be click forward balances, then your balance sheet or the trial balance will
Just
balance.
I'll just give you just I need one thing to know. The suspense account, when you do the suspense account on the trial balance, suppose something is, so what we do at the end of the time, we have to look for the real things, or we'll keep like a suspense account whole until the
Yeah, so
balance is.
suspense account don't goes in the final accounts.
No, I said, yeah, I know, but when you do the trial balance, okay, something is missing, maybe its balance is not the same, so we make a suspense account. So what we do at the end of the trial balance, we have to look for the actual error, or we'll keep like this.
Always good to be go back your T accounts,
Yeah.
all ledgers, and look around. Why not? Because if you have a cash sale, so maybe you record it in sales, you miss in the cash book.
Okay.
So you need to be look around. Now you put in the cash book, and because your sale was right, and you can credit side, you can put it suspense account. But the suspense account at the end and the start, you putting things, and that will be removed. That won't goes in the balance sheet then. But your cash
Okay.
book can rectify automatically.
Okay. Thank you.
Welcome. Okay, then we have a VAT control accounts. Yes.
Yeah.
Always remember, guys, VAT always goes in the same side, whichever side that click will goes. Yes, my expense goes on debit side, VAT on expenses will goes on the debit side. Debit
Mm-hmm.
side in the control account, VAT mean refund from HMRC. Credit side mean I supposed to pay to HMRC.
Mm-hmm.
Okay, this is sale ledger control accounts we can prepare. Yes, when we have a credit sales, and if bad debts are also irrecoverable, and bad debts can be adjusted here as well. Yes. So
Yeah.
if we have a bad debt, that can be treated for VAT. Is it what is the rule for bad debts? Is six bad debts need to be 90 days at old. Huh? If your bad debts is less than 90 days, maybe you get the money. You can't get it
Yeah.
refund VAT on bad debts.
Yeah.
That's we need to think about. And the purchase ledger control, which is mean trade payable, also known as a creditors. When we have a credit purchases, a link with the purchase day book and can be linked with the cash book. Okay, gross margin and markup, always keep in mind. Markup is always based on the cost plus, and the margin is always based on the sale price. So if you using the word margin, it means your sale is 100%
Mm-hmm.
and your cost is 80%, and 20% will be your gross profit. I'm saying 20% margin, so it means 20% my gross profit. Yes, 100% my sales and 80% my cost of sales. When I'm
Mm-hmm.
using the word markup, let's say
Yeah.
20 or 25%. So 25% is my gross profit. but cost of sale will be now 100%.
120%, that means.
Okay, yes, because it's a plus now, cost
Yeah.
plus gross, and that will be my sale value. That's, the key difference between two terminologies. Huh? That's
Yeah.
always carry on happening, and we need to keep in mind when we prepare in accounts. Okay, then stolen, destroyed inventories, always we need to be look around. Yes, what's happened, real value, we need to be make adjustment in stock inventories. Cash book, we know is two column, cash and the bank, yes, and the bank normally is keep. So we do our record and bank do their records, huh? And that's exactly the current account in the partnership, which is exactly the same logic as well, like like your account in the bank,
Mm.
the partner account in the business, huh? So when the profit will happen, so we can credit there and debit there. Okay, drawing always we do debit, yes.
Yeah.
So that's debit and credit rules, guys. Maybe you think the reason I'm including a slide to meet the criteria, but if you need further explanation because you all work in accounts, I'm not going bit and pieces. Yes, but it can be. Yeah? So if any question, anything you can ask. Okay, next now we discuss the statements, how the statement will be look like. Statement profit and loss, first thing always come revenue, cost of sales formula, opening inventory plus purchases minus closing minus your expenses, you will get the profit from operation before tax, after tax. Then asset, yes, non-current will come first, current will come after. Liabilities we can minus from, and we can find net asset and net asset figures. Always keep in mind accounting equation. We all know accounting equation, yes?
Yeah.
Okay, so assets
Asset equal to,
always
sorry.
equal
Yeah.
liabilities plus capital.
Capital
If you need to look around, you can say assets minus liabilities
equal to
equal
capital.
to net asset, and the net asset figure, if you know, that should be equal to capital. It means your capital.
Yeah.
Okay, that's we can use this same logic to when we prepare the final account, financial statement, formats, working. Yes, inventories, adjustment, balance carry. So balance carry down is going, yes. So you can transfer figures when you transfer, so you can close off your T accounts. Huh? Okay, that's we carry on doing in accounts. Partnership, as earlier we mentioned, so statement of profit and loss when you're making partnership. So this is sole traders when you're making, but when you're preparing the partnership, so no here the profit for the period. Yes, that will
Yeah.
be shared between partner, or we call residual profit. Huh? The residual profit, and that need to be. So then we have like here, this is the profit we have, and we have a partners, yes, and
Yeah.
whatever the sharing ratios, and we can share between partners. And here is,
Oh, I have one question here.
yes,
When we do the partnership profit account, that means the income statement. So if the new partner is admit, that time we have to do the separate statement, like half of the year the new
no,
partner
no,
is
no,
in.
you will do the same statement. You have to look around how many months back, whatever your agreement, because the profit you're distributing, you're not touching the statement. Statement is the same like you
Same
preparing the,
statement, but I have to do the like 8 months and then 4 months. It's like that. The
depends
same.
your agreement. Yes, you can.
Okay, but do I need to do the like a revaluation account or something, or no? We don't need to do anything. Just
No, you have to do partners current account and partners capital account.
and the balance sheet.
No, balance sheet won't, but yes, partners capital will goes in the balance sheet. So you're doing the debit your cash and credit your capital, huh, which you make
Mm.
the capital accounts. Huh. There is
Okay.
elements of goodwill you need to be adjusted.
Okay.
Okay,
So
like here you see
yeah,
partners, yes,
yeah,
capital accounts. So here we have examples as well, huh, in the next slide. So that's your partners capital accounts, yes.
Capital account, yeah.
So normally it's credit side previous partner. If it's new partners, yes.
Yeah.
Because your
Hello.
yes, welcome. So
Yeah.
partners capital will goes on the credit side. When somebody withdraw, we put on the debit side.
Yeah.
Okay, their current account, which is part of the capital, yes.
Yeah.
So you will see the balance, partners. So salary was the expense for the business, but salary was the income for partners. If partners is working and getting salary, yes.
Yeah.
If the partner withdraw the money or give my capital investment, so partner
Mm.
entitled to charge the interest on it. The interest will be income for partners.
Okay.
When partner withdraw money from the business, so that become drawing, and the interest on drawing is the expense for partner's current account, but is the
Yeah.
income for business. So in the when we'll prepare the profit and loss, interest on drawing will be income for business.
Income for the business, but the
Expense
interest
for
for the expense for the partner, and it
partner.
will show on the current accounts.
Yes, so we can show under the current account.
This drawings means that there's a taking the part of their profit.
Yes,
Is correct or not?
no, drawing mean they are draw money from the business for personal use.
Yeah, that's something they're taking like their like a portion of their profit, just
Oh, yes,
withdrawing.
portion of their capital if they want to withdraw some money for personal use. Because when you invest it, it becomes a company money. They can withdraw the profit every year. Yes, no
Yeah.
problem. Yes. So not every profit, but whatever the policy we have between partners. Huh?
Okay.
So then that's the balance. That's we need to show in our partnership. Yes, we can add new partners. We can make adjustments. Yes, there will be. We can make retirement partners. Yes.
If new partner is in, that means is we have to do, that means revaluation the asset for the goodwill, or
Yeah. Yes. Partners. We can create goodwill and we can eliminate goodwill.
okay.
Okay. So what we do, we can say goodwill account debit first,
Mm.
capital accounts credit first, and then we
That
do
means
the
the old
debit
partner
or
capital account.
yeah. Then partners capital account we do debit, and then goodwill credit. So goodwill automatically will eliminate, yes.
Just I have things. That means the goodwill
Because
account we are opening,
yes,
then with
old
the old
partner
partner with the old ratio. That
with
means
the
old
old
ratio
ratio
means,
and the new
yeah.
partner with new ratio then.
And then when we do the next one, the capital account debit, that means we have to make a sacrificing ratio for the old partner, and then
Because
you need to calculate.
old partner getting benefit due to the goodwill because they have created many years. Huh? So
Yeah,
their capital amount will be, because when new partner will invest, them all the money not goes to the new partners, but that money can be transferred to the old partner, some
yeah.
proportion of it. Yes, because the reason is because the old partner is number of years in the business. Huh?
Okay.
Okay, that's further we can do the question. I'll send you the booklet, yes, with the answers, so you can look around further, huh, to explore it. New partners, old partner retired, yeah. So all the
Mm.
questions. And I copied the links. If you want to further read, please do so as well. Anybody, any question? So today lesson we discuss about partnership accounts. We discuss about sole traders, and we discussed the difference, and we mentioned the limited companies, and we discussed the basic W3 bookkeeping and type of depreciation methods. That's all. And the user of financial statement, all stakeholders, those have any interest in the business, those are all this like customer, like suppliers, like HMRC. These are all the user of accounts. Huh? Any
Okay.
question?
Yeah, this is fine. But this our class is finished, or because I need to.
So what we'll do, I'll end of lesson, I'll send you the booklet. Yes.
Yeah.
I'll show you. Okay, so we'll keep up to here. Anybody any question before? And that's all today, guys. Today we learn about the sole trader partnership account, and with adjustment, what we can, we can't, types of errors. We discuss the depreciation, and that's all today lesson. And the next lesson we'll go through LO2, which is learning outcome 2. that will cover our company's accounts.